The first thing that I wrote about was a forecast model that I built, and I was forecasting both oil prices and rig counts out to 2030. The reason I did that was a client had reached out after seeing another post that I had written about forecasting on LinkedIn, and this client was asking, he worked for a big oilfield equipment provider, and they were making some capital allocation decisions that would require, returns would occur over, say, a 5-year time horizon. So they needed some understanding of what oilfield markets may look like out to 2030. And it's easy to, understand that forecasting oil prices and rig counts in the next few months is hard enough, right? Out to 2030, the uncertainty can be enormous. So it's easy to acknowledge that and then just say, okay, fine, we're not going to forecast anything out to 2030 because it's fundamentally unknowable, and why would we waste our time doing that? The challenge is that, if you work for a massive oilfield equipment supplier, your capital allocation decisions hinge on what happens years in the future, whether there's an enormous amount of uncertainty around that future or not. These capital returns estimates require, or at least are sensitive to, what happens in those future years. So there's one option where you say, okay, we're not going to build a forecast. We're going to, there's too much uncertainty, so we'll make a decision one way or the other around our capital program, but we're not going to waste time building up a formal forecast. The challenge there is you will still rely on a forecast of sorts. It just won't be a formal forecast. You'll rely on heuristics or anecdotes, or what you happened to read most recently, or a podcast episode you listened to most recently. It might be the collective judgment of a team that's involved in making that decision, but implicitly there is a forecast embedded in the decision, because you have to decide whether you think it's going to be worth, whether you're going to generate the returns required to justify deploying capital over that kind of time horizon. What I argue is that knowing that you're going to make a forecast explicitly or implicitly, it is more valuable to make it explicitly, because you can then challenge the assumptions that you make, and not just challenge them, say, yourself. I mean, you can discover those assumptions, which isn't always the case when you rely on implicit forecasts. You're just casually kind of interacting with a team. Here, you're documenting your assumptions, you're designing a methodology, you're being deliberate around what data sources you're going to pull in to build this forecast. And then you can interrogate all that yourself, but you can also socialize that and involve a team and, kind of triangulate around what areas of strength exist in this methodology and what areas of weakness. And given, what, say, the first pass of our forecast model is telling us, does this pass the sanity test? Does this look like, does it give us the kind of behavior that we would expect of a real oil and gas market out into the future? In what ways is what it's telling us sound most plausible, and in what ways does it sound the least plausible? We can use that to refine and better understand why we've made the decisions that we've made to build this model, and that helps us build an even better model, knowing there's plenty of uncertainty. There's no one that's going to be able to forecast what potential sources of geopolitical conflict might exist in 2028 or 2029 or 2030. But that's not really the point, right? Because that's unknowable no matter how you go about forecasting. But there are some elements of the structure of oil and gas markets that are understandable and can help inform a capital allocation decision. And that's why I argue being explicit about building a forecast is a good thing. That does not mean that you have to over-engineer a forecast. It doesn't mean you need to make it a 6-month exercise and pull in a team of people and just go crazy with it. But what it does mean is putting pen to paper, a little bit of work, a little bit of rigor, a little bit of data gathering and organizing and analyzing can go a long way. And that's exactly what I helped a client do. And that's what I wrote about on LinkedIn, is the process by which I built that 2030 outlook and what I learned about oil consumption. The short version is, oil consumption is very robust. I was pulling data down at the specific country level. So per country, pulled some demographic data, pulled some aggregate oil consumption data. You can use that to get to per capita oil consumption. You can start to trend that stuff out over time, see how volatile it's been historically, you can make some assumptions around how much you expect that to grow or decay into the future based on what's happening with the energy transition. But when you have all these data sets to build on, you're fundamentally bounding or constraining your forward outlook. You get a sense of what could be reasonable departures from historical trajectories versus what would require truly an unprecedented near-term step change that looks less plausible. And so going through all those data sets was very helpful for me because I had more confidence in understanding what oil consumption could look like out to 2030. And when you do that, then you can start to estimate how pricing and production and rig counts can evolve and how they are interdependent, and how you can build up a system where that stuff behaves the way a market would behave, where prices are sensitive to supply relative to demand, and the prices then drive activity levels, which ultimately drive production. You can put all those pieces together and really start to build a coherent model that gives you some useful information about the future, and that you can use to triangulate against other forecasts you have or other assumptions you're making, and it just strengthens your conviction in whatever decision you end up making in your capital allocation program. So that was the first post that I wrote about on LinkedIn this week. The second post was about Phillips 66, the big U.S. independent petroleum refiner. And when we think of Phillips 66, it sort of lives in a class with Marathon Petroleum and Valero, where the U.S. has three large independent petroleum refiners. They're focused on refining. There are some biofuels elements to each of them, so it's not strictly petroleum that they're dealing with, but dominantly that's their business model. And that space is interesting for all the reasons you might imagine. That's the domain that's producing the gasoline, the jet fuel, the diesel that shows up all over our economy, that moves people and goods where they need to be, and frankly allows the modern economy to function the way that it functions. So this petroleum refining sector is a critical sector to follow. It doesn't probably get as much visibility in the business press as its economic import would lead you to believe, but that means there's more, frankly, for you and me to study and explore and reflect on. So I wrote about Phillips 66 because Phillips 66 has been in the news a great deal with Elliott Investment Management. That Elliott Investment Management is an activist investor firm that takes positions. The ones that I've heard about are in publicly traded companies, and then in some cases argues to take on to place board directors in these companies to help guide changes, strategic changes that Elliott would like to see these companies make. And Elliott has made a handful of investments in the oil and gas space at Suncor and has elsewhere. And so Phillips 66 is one of their more recent ones and one of their more visible ones that Elliott believes that Phillips is underperforming its peers, specifically Marathon and Valero. They think that there's some refining acumen missing at the senior executive level and possibly at the board level. And there's also complaints that Elliott has that Phillips 66 also has a stake in a chemicals joint venture that it shares with Chevron, and Elliott would like to see them divest that chemicals exposure. They'd like to see Phillips 66 divest some or all of its midstream exposure, and really just simplify down to a pure play refining business. And Phillips 66's management team has argued very forcefully that this integrated portfolio that they have offers them a lot of strength, that there's some counterbalancing forces there, so that through different economic environments, Phillips 66 can generate the cash and sustain a CapEx program that's optimized across a cycle, rather than being super sensitive to whether you are at a peak or a trough of a cycle and having to whipsaw your capital allocation program accordingly. That there's some stability that this integrated portfolio has that allows them to invest more confidently and offer better returns. Elliott takes the opposite side of that argument and argues that if you separated those assets, some of those assets would be worth a lot more than they are when they're tied inside these petroleum refining portfolios. And so investors should have the right to be able to invest in just one segment of those and not be forced to invest in all the segments, because when you bundle them all, there's a lowest common denominator element that drags the collective valuation down. That's the Elliott argument. So there's real debate to be had there, because you can't prove from first principles whether one valuation argument or the other is preferred. So you have this tension, this, frankly, to some degree, sort of conflict between Phillips 66 and Elliott. And so what I decided to do was take a look at Phillips 66's returns, their returns on capital over time, and compare those to what we see from Valero and Marathon. And we see that, coming out of the pandemic, as you get toward the peak of the pandemic, that recovery, then since then, Phillips 66 return on capital is indeed lower than what we've seen for Valero and Marathon. So that's not surprising because, Elliott made a big case about this underperformance being core to his argument. So it would be, frankly, kind of surprising if Elliott did all this work and decided there was a performance deficit and deployed, hundreds of millions, if not billions of dollars into these positions, and then realizes, whoops, there's really no performance deficit here. No, there's a performance deficit. Now, we can argue about the size and scale and durability of that deficit, but the deficit existed, and sure enough, in the work that I did, you can see this deficit in returns on capital for Phillips 66 relative to Marathon and Valero. Now, what gets interesting is returns across this whole sector have declined pretty aggressively since they peaked in late 2022, early 2023. We've seen sort of a straight line decline in a lot of these returns, where now we're getting down toward low single digits of returns, whereas at the peak coming out of the pandemic, you had 30 to 40% returns, and now we're 5-ish% returns. And that gets interesting for Phillips 66 because the gap that Phillips 66 had relative to Valero and Marathon has effectively vanished as they've all collapsed more or less toward zero. That offers Phillips 66 an opportunity here because we'll see some sort of recovery, some sort of normalization in capital returns going forward as profitability expands in this sector. And that offers Phillips 66 a chance to demonstrate to the market that, look, we've been improving our performance. We've been improving the operational efficiency of our refining base. And we've been improving the commercial terms on which we're, say, buying crude and selling the petroleum products on the back end. We're making a lot of these improvements. And now as the market eventually becomes healthier for the petroleum refiners and we see returns and margins expand again, this is the case where Phillips will be able to argue back to Elliott and its broader shareholder community that, look, we've made the kinds of changes that we needed to make to catch up with our peers, if not surpass our peers. And now the proof is going to be as we get into an environment that allows all of us to really demonstrate the capabilities of our performance going forward. So there's a little debate that Phillips 66 historically has had some sort of deficit, and the real open question is, okay, as this sector recovers from here, are we going to see Phillips rise with everyone else and at least catch up, sort of maintain the pace of its peers? If not, actually race ahead of them. So it's going to be an interesting element to watch, and it's one of the core areas of tension that exists between Elliott and the management team at Phillips 66. My next post on LinkedIn was about the chemicals space, and what I had written about was that stock prices for chemicals companies are way down year over year. We saw that. I noted that Dow's stock price was down 55% year over year, and LyondellBasell's was down 42%, and Westlake's was down 56%, which is really ugly, right, to see stock prices get cut in half, particularly these big industrial players that don't have a huge room to pivot aggressively from quarter to quarter. These are massive assets that are meeting core demands of the world, of the global economy, and so these valuations, when they get on this kind of roller coaster, it's a bit wild to certainly to watch from the outside, but absolutely to live in the context of on the inside. And so what I showed was that it's really a revenue story for a lot of these companies. I track every quarter financial performance data for a collection of $15 billion plus publicly traded chemicals manufacturers. And what I did on LinkedIn was showed a chart of the revenue for this group of 15 chemicals manufacturers. And you see what you'd expect to see sort of going into the pandemic. There's a flat to slightly declining revenue base. You get into the pandemic, it drops. Then you get this recovery, this pretty aggressive recovery that we see in almost every energy and industrial sector, and just more broadly across the whole economy. You just see a ramp up, coming out of the middle of 2020. A lot of these recoveries peak sometime in the 2022, very early 2023 at the latest time frame, depending on what sector of the economy we're talking about. So revenue for these 15 companies that I track peaks in the first half of 2022. And then we've seen a pretty steady erosion of revenue in the past 3 years. And when revenue continues to erode quarter after quarter like this, it absolutely weighs on the income statement, on the company's profitability. And as earnings go down, the stock price will go down with it. That's not a shock. And so then, the next question is, okay, why is revenue declining this aggressively? And what I showed in addition to revenue in the chart was the producer price index for industrial chemicals. And we saw that chemicals pricing rose a lot from the depths of the pandemic up to the recovery. And then almost the quarter that industrial chemicals pricing rolls over, that's when you see revenue roll over for this cohort. It gets kind of interesting that the producer price index itself has flattened out over the past year and a half or so, 2 years. And yet revenue across this chemicals cohort continues to erode. We saw a little bit of a recovery in 2024 of revenue, but then quickly, as you get toward the end of 2024 into the first quarter of 2025, you get the continued erosion in revenue. And one thing that I noted in the post on LinkedIn was a quote from Dow's CEO on their earnings call. They were asked about, the management team said they have a lower for longer, they described a higher probability of a lower for longer earnings environment. And then the first question they got after talking about this lower for longer earnings environment was, whether that view materialized before tariffs were announced or after tariffs were announced. And the CEO's response, I'm quoting here, is, I think with the situation that we're in now, with the uncertainty around where tariffs are going to land, with the impact that's having on demand, that's driving our lower for longer outlook on the environment. That's the end of his quote. And so tariffs are making a big difference here. And it's not surprising, right? Because the global chemicals are highly traded, just given that supplies are relatively concentrated, demand is reasonably widespread. So you do get a lot of freight traffic in the world of chemicals. And so any disruption to global trade patterns will absolutely hit these chemical makers hard. We see it in their stock price. We see it in their revenue streams. It's a bit of pain that they're in right now. Like a lot of these energy and industrial sectors, there's a cyclical reality to this. So they're at or near the depths of one of these cyclical lows. There will be a recovery to come. But when you're in the midst of something, like this that has this kind of pain, it creates some consternation and the visibility and the commentary that we're seeing out of these chemicals management teams. My next post was, in a sense, kind of a follow-up. It was also about chemicals. And what I did was call out specifically some of the results from LyondellBasell that in its most recent earnings call, one of the stock analysts posed this question, and again, this is a full quote from the stock analyst. This analyst says, just trying to get a handle, I guess, on the capital spending on a go-forward basis. With all the large projects, can you kind of bucket the capital outlays for 25, 26 on the larger product projects and what the underlying spend is there? And how much flexibility do you have to throttle that back if we go lower for longer in this trough? It's the end of his quote. That I wanted to highlight because that question is built around this notion of capital discipline. And we hear about capital discipline a lot in the oil field, that investors are skittish, frankly. They're concerned about what the medium to long-term demand for oil specifically looks like. And so in order to justify investing in oil and gas companies, they want to see, the management team have a real bit of conservation around how they deploy capital in their business. They do not want to risk investing a bunch of capital in projects into assets that get stranded, right? If oil demand really does roll over more quickly than oil and gas companies hope it does, then you could potentially have stranded assets. And these investors do not want management teams today deploying capital in a way that creates assets that get stranded when at some point oil demand rolls over. So there's concern around that, but then if you're not going to deploy capital into assets that could potentially become stranded, why don't you just give that capital to me as a shareholder and either write a check to me in the form of a dividend or buy back your stock from people that are willing to sell it back to you so that the stock that I continue to hold now represents a larger ownership stake in the company. And so, with that, the stock price can go up. I get, in principle, my dividends may get larger depending on how you structure your special dividend programs, and just everything for me as a shareholder gets a little bit better if you're buying back stock from folks that are willing to sell it back to you. So we've seen a lot of this commentary in the oil field, but now we're seeing it in the chemicals space. And the fact that LyondellBasell would be asked specifically about it, and that the question would be biased in a way where we're asking, hey, sort of explain to me your philosophy around capital allocation right now. And then specifically, I'm going to ask, to what extent can you throttle that back? And that lower for longer reference was a reference, of course, to the Dow CEO, to that commentary that they saw a lower for longer earnings environment. And this analyst is curious, is, hey, if this lower for longer environment is going to exist across the chemicals space, then how about all these chemicals companies pull back a bit on their capital programs? And again, instead, steer it back into dividends, steer it back into buybacks, into other ways that give shareholders an immediate reward, rather than speculatively betting on building out an asset base that may or may not generate returns in the near to medium future. There's not really the medium to long-term concern around chemicals that exist in the world of oil. The chemicals demand is expected to be much more robust and to grow reasonably aggressively as we see more development around the world. Even if you get into an aggressive energy transition scenario, there's going to be a lot of demand for chemicals for across a wide swath of applications in the global economy. So it's not really a concern that chemicals demand somehow is going to roll over. But when you get uncertainty around, what kind of demand manifests where and how quickly, when you get uncertainty around that, in today's environment, particularly with the cost of capital going up and with all the questions around trade wars and the friction that may continue to grow in global trade, then, hey, why don't you just kind of sit this one out and give me some extra cash and I'll do with it what I want. That's in a sense what some of these shareholders are asking, and some of the analysts are asking as a proxy on these earnings calls. My last LinkedIn post of the week was about the cost of debt and how the cost of debt is going up. What I showed was a chart of the yield on 10-year U.S. Treasuries since the beginning of 1962. And we see that, from, say, 1962 up into the early 80s, there's just a spike as yields go up and up. We get this, very turbulent period in the late 70s into mid 80s of extraordinarily high interest rates to try to combat, crazy inflation rates. And then you have from the mid 80s, late 80s on into 2020, just an ongoing reduction in yields on these 10-year treasuries. And then since the pandemic, we have an increase in yields. And so when we talk about yields on U.S. Treasury, this is in effect the cost, what the reward that investors are demanding that the federal government pay them to hold the debt of the federal government. So if yields are going up, that means that potential investors are demanding more payment to hold on to that debt. And if yields are going down, then these same investors require less justification to hold on to U.S. debt. So as we've seen yields climb coming out of the pandemic, and they continue to climb into today, what that means is that investors are demanding that the government pay them more to issue new debt. And so the interest on the federal debt goes up, and that creates more cost for the federal government. And then there's a lot of debt in the economy that is tied to, that references the yield on 10-year U.S. Treasury notes as its benchmark. There's a lot of corporate debt that's benchmarked against the 10-year Treasury. There's mortgage debt that's benchmarked against the 10-year U.S. Treasury note. So as these 10-year U.S. Treasury yields go up, not only does the U.S. federal government have to pay more to finance its existing debt, but people have to pay more to take out loans on their houses. Companies have to pay more to take out loans to invest in the business, to stand up new assets, to pursue an acquisition, whatever they end up using their capital for. So all of this is just more cost, and that puts real pressure on economic growth. It makes the hurdle rates required to justify investments go up, and so companies are less likely to invest, and so we'll just see less growth, we'll see less activity. It rewards savers, so it's not that this is bad for everybody, but anyone that has, you think of pension funds as sort of the classic case there. They do better in a high interest rate, high yield environment, and so it's not that things are universally bad for everybody, but it is a swing in the economy away from growth towards savings, away from investment towards savings. And that has a real impact on the performance of businesses. So it's something that, particularly in the energy space, where it's such a capitally intensive endeavor, It creates real friction. We saw it on the LyondellBasell call where they were asked about, hey, why don't you throttle back some of this capex and instead hand it over to shareholders? It also, when you think of the energy transition, higher interest rates uniquely harm variable renewables deployments. So when you think of solar or wind, or to a lesser extent batteries, there's really no fuel costs for these technologies, certainly for solar and wind. And for batteries, the extent to which you're paying for fuel, you're typically buying electricity when it's cheap and turning around and selling it when it's more expensive. So there's an arbitrage element there. So these technologies are not real sensitive to the cost of fuel. And the cost of fuel, say, dominates oil and gas installations. And instead, with these variable renewables, they're incredibly sensitive to interest rates because you deploy all this capital up front to build out a solar farm, to build out a wind farm. And then you recoup this money over time. And so when interest rates go up, it just means the cost of your financing is a lot higher. It takes more dollars over a longer period of time to get a return on these investments. And so as we see this cost of capital climb, we would expect on the margins to see fewer solar deployments, fewer wind deployments, fewer battery deployments. And then we hear in Congress about rolling back some of these IRA incentives, which would be another tap on the brake pedal against what we see in solar and wind and batteries. And so this sort of environment that we're in right now is uniquely painful for variable renewables. And it's something that requires us to pay a lot of attention to because these variable renewables have represented a lot of the capacity increase that we've seen in the world of power generation in the past several years. So cost of capital has big effects across the world of energy. It's uniquely painful in the world of variable renewables, which of course is a space that's collecting a lot more capital as we go ahead. So that was a summary of what I published on LinkedIn this week in a little bit more detail than what I'm able to write given the characters counts that exist on LinkedIn proper. I hope you enjoyed listening to it. If the feedback to this is good, I will probably try to stand up a weekly podcast where I do something like this and just summarize a bit of the research that I've written about there, so you get a little bit more context, a little more perspective around how I'm thinking about what I'm writing, why I decided to write what I've written, and what it means as we try to build our mental models around what's happening in the world of energy. So thanks a bunch, and we will talk soon.